you hate the thought of working past 55 or 60? Do you hate not being able to live the life you deserve today? Do you hate not knowing what your financial future looks like? It's time to stop doing what you hate. Here's your host, Mr. Harold Green.
Hello, everyone. This is Harold Green of Bright Tree Wealth Management, and it is time to stop doing what you hate. I hope you are having a fantastic day today, and looking forward to sharing today's show with you because it's going to be a very important one. But I usually like to start off by talking about my week, but the last few shows I probably hadn't said anything about what's been going on with me. And I can't tell you everything, but I can tell you about this week. The other day, I got in the car and, actually, even before I got in the car, I woke up early that morning. I was recording, I was working, trading, doing crazy stuff, and I wasn't feeling all that hot. And so I went and laid down for a while after I got done with work. It came around about, it was evening or whatnot, and I got up. And I went to the sliding door in our living room out to the deck and patio area. And I was like, man, should I go for a walk today or should I go to the gym? And I was like, walk or gym? So my wife came up beside me and she's like, what's the temperature outside? And I was like, it feels pretty good. And I'm like, you want to go for a walk with me? And she's like, nope, maybe not today. So I was like, all right, I'll tell you what, I'll go to the gym. So I took some pre-workout stuff that I usually take, got in the car, and got out of the garage, and I saw my neighbor. I saw my neighbor across the street with his baby, and his little girl. She's toddler now, and I said, "You guys going for a walk?" And he was like, "Yeah, we're gonna walk to the park and hang out for a while." And I said, "I was thinking about going for a walk, but I'm probably just gonna go to the gym instead." Like right there, I had felt the urge to like back my car up, put it back in the garage, and join my neighbor and his daughter for a walk to the park. That's what I think I should have did. But I didn't. Got in the car and I was heading to the gym, and out here in Vegas lately, people have been driving really crazy. And I said, you know what? I got to take care of myself, and I got to make sure I'm driving not only for myself but crazy people on the road too. And I was going down the hill, and there's like two lanes, but then there's this exit lane, and I found myself like hung out in the exit lane, and I shouldn't have been there. And if you stay in the exit lane, you're going to be forced off the freeway, and then you got to figure out how to get back on. So instead of doing that, I sped up to go around on the car in the exit lane. And as soon as I got around the car, I slowed down. But I was like, okay, I'm good now. I slowed down, and I get down to the bottom of the hill. There's a cop waiting down there in a motorcycle. And he's like, pulls me over and everything. And he's like, sir, sir, you were going almost 100 miles an hour. I said, what? I wasn't going that fast. He said, well, my partner has you on the body cam up there on the camera. Like, I said, did you see me trying to go around the car so I didn't get forced out of the exit? He says, yeah, but you're going too fast to do that. I'm like, all right. All right. So he wrote me a little ticket and stuff like that. And I was like, man, I haven't gotten a speeding ticket in 5 years. And the crazy, ironic thing about it is I got a ticket doing the same thing 5 years ago. I was like, yo, you need to, this is because it's not a habit, but I was like, all right, I wasn't using my best judgment. And I didn't tell my wife that day because I was still in a little shock because I don't like getting speeding tickets. I don't like getting infractions or doing things that are like outside of character. I like being transparent and stuff. And so I told her the next day, and she's like, why didn't you tell me the day before? And I was like, well, I was in shock a little bit. And I was like, and she said, we talked about it a little bit. And she said, that's really not how you want to be spending money. And I said, you're absolutely right. I should have like caught myself and slowed down it or did something different, or maybe even just went for the walk. And I went to bed early because I just wasn't feeling good, and went to bed early, and so she came in and she caught me listening to my podcast show, my shows. And I do that sometimes before I go to bed, I listen to my shows just to kind of like, re-up on some of the things I've been thinking about. And she said, who are you listening to? And I said, honey, that's me. And she said, if you talk like that to the cop, maybe he wouldn't give you that ticket. I said, honey, I did, and it didn't work. I got the ticket anyway. And then she was so good about it. And she said, maybe there's something going on with you that, you might need to do a reset, or you might need to calm down. Maybe you're stressed about something and you don't know it. And I was just really grateful for her to be kind about it. Because if you know my wife, like any kind of thing that you do, like she's usually on it, right? You spend a dollar too much on something, and she's like, "Yo, what's up with this?" Like she's usually on top of it because she's our controller. But I really appreciate that, and it gave me time to kind of sit back and reflect on where we are in life and what things are most important. So what I really want to say is when you hear this message that I'm about to give you guys today, I really want you to sit down and think about what's most important and just kind of reflect, and then don't make knee-jerk reactions. Don't overreact to certain things, but just try to like calm down and think things through carefully. And this is episode 7 of our ongoing series of financial advice versus financial propaganda. And so far in this series, we've exposed how Wall Street manufactures narratives and how financial media amplifies emotion and how retirees are quietly pushed into decisions that they feel logical in the moment, but they're devastating over time. And so today we're tackling one of the most uncomfortable topics in all of finance. And I've talked about this before, but I want to talk about it today in a way that maybe you haven't heard it, or maybe in a way I haven't said it. And a client the other day, he texted me and he said, I should grab the text, but he said something about when I show people my portfolio and the first thing they ask me is how much am I paying in fees? I tell them, he said, you should see the look on their face when I tell them I don't give a crap about the fees because Harold's taken my portfolio from zero to hero, from financial chump to financial champ. And he said they just look crazy at him. And because it's like this, it forces us to ask a question most people never really think to ask. Who actually gets paid when I follow this advice? A lot of times people say, well, Harold, how much do you make off of this? How much are you making off of me? And they ask it in a way as like, okay, like they're my employee and they're generating income for my business. And they look at it in a negative light. And so today I want to share with you how you should be looking at this. The problem is that I wouldn't say it's a problem. I would say this show is geared more towards people that aren't working with anyone who's trying to do things by themselves. And they're either trying to do buy and hold strategies because they don't want to pay high fees in mutual funds, or, they want the lowest cost ETF, but they don't understand the hidden risk and fees and hidden incentives. And those are the forces that quietly shape the financial recommendations while remaining invisible to people paying the price. And here's the most important thing to understand up front. Most financial harm doesn't come from bad markets. It comes from misaligned incentives. And I want to talk to you folks about the illusion of free advice, or free trades, or free this, or free that. Many people believe they're getting advice for free, and they're told stuff like, you don't pay me directly, or there's no cost to you up front, or I get paid by the company, and my services are included. Or, like these solar deals is like, well, you're going to get a rebate here and there. And it's like, okay, are you paying more for what you're getting than you should? And a rebate is just a overpayment of service. Like you have to look at that. But in finance, nothing is free. And if you're not writing a check, you're paying it in a different way, often through a couple of different things: higher internal fees, reduced flexibility, hidden commissions, opportunity costs. That's a big one. Unnecessary complexity and increased risk, or permanent illiquidity, right? You get this thing as free, it is locked up for 20 years. You can't get the money out for 20 years. There's no fees, but you can't get the money for 20 years. That's going to cost you big. And the most dangerous costs are not the ones you see. They're the ones you never knew to look for. And this is the same thing like when people sit down and they talk to a financial advisor for the first time. People run away because number one, they think they don't have too much money. And number two, they think, even if they have money, the guy's going to charge too much. So why even bother? And like I told this lady the other day, the problem is not knowing, right? You don't have to sign up on the first meeting. You can just go in and get the information. If you don't like it, you can jet. You don't have to stay and pay. And here's why fees matter more in retirement than any other time. And this is more specifically for buy and hold, okay? Not for active money management. That's a different conversation. And fees, they can hurt you, but they can hurt retired people more than anybody else. And the reason why they hurt because of lack of performance. That's the only thing. It's a lack of performance. And if I make you, and this is an investment show, and all investments do carry a risk of loss, past performance is no indicator of future results. And before you invest, you got to do your due diligence. Make sure you're investing according to a well balanced, comprehensive financial plan that are aligned with your risk, your time horizons, and all these other things. And get a couple of different opinions if you would, please. And that'll help you. But fees can hurt, and here's why. Because in retirement, you're no longer contributing. Your portfolio must support the withdrawals. And compounding works against you if costs are high. And small drags become permanent income losses because, again, the performance is not there. A lot of times people want to blame the fees. Well, if I'm not paying fees, and I even had some guy show me this chart like, well, if you have $300,000 in your investment account and it makes on average 10% a year, and your advisor is charging you 1.5%, what is your advisor going to make you over 30 years? And it was something like three or $400,000. Okay. And they put that number like right there in your face. I'm going to pay him $300,000 and this is all I'm going to have. Like, I'm not doing that. Well, if you come over here and you buy this product or that product, you don't have to worry about that. This is your growth. But it was all like internal fees and things like that. And a lot of times retirees they end up paying far more than they realize, not because they agreed to knowingly, but because the system was never designed for transparency. And this is also for people that are not working with fiduciaries. As fiduciaries, they're required to show you exactly what you're being charged every quarter. You have to give your clients an itemized statement, and you have to be able to explain all the fees on there. So there's trading fees, there's ADR fees, there's early redemption fees if they're buying these mutual funds. These are all things that have to be explained in the statement. And what we do for our clients is we download their statement every quarter in their e-money vault, and they can go back for the last 5 to 10 years and see exactly where they came from, add all the fees up. And if they think they paid me more than what I made for them, they're free to leave. But nobody ever does that. And I'll tell you why at the end of the show. The three categories of hidden damage, they're this. Almost every financial product or strategy, they fall into one or more of these categories. Either hidden fees, costs that never show up clearly on a statement, hidden risk, dangers that only appear under stress, and then hidden incentives like motives that shape recommendations without disclosure. That's standard, that's industry standard. Okay. That's non-fiduciary industry standard. In this episode, what I want to do is I want to break down all three. I want to do it clearly. I want to do it calmly, and I want to do it without hype or propagandizing this stuff and just kind of like trying to preach my own gospel. I don't want to do that. Because once you see how the system actually works, you can't unsee it. Right? You ever heard that? Like, oh wow, that guy, he took his shirt off and it was just like you can't unsee it. Sorry. That used to be me at the beach with my kids. And somebody I was so fat, I was like almost 400 pounds, and somebody's like, is that Biggie Smalls with his kids on the beach in Hawaii? Like I was like, oh my God, dude, you seriously need to lose weight. And I think I probably lost about 150 pounds since then, but I was crazy. And I want to talk about what this episode is and is not. This is not an attack on advisors. This is not an attack on institutions, and this is not a call to abandon professional help. And this is a call to understand how advice is monetized, how incentives shape behavior, and how retirees can protect themselves. Good advice, it exists. Ethical professionals, they exist. But blind trust is not a strategy, especially in retirement. And one of the things I have to constantly tell my clients all the time, they're like, Harold, we trust you. You've done such a great job. I said, I know you trust me, but you still need to be able to explain how your stuff works. And you still need to be able to understand what we're doing. And because it's an ongoing educational process, not only do I do these podcast shows, but every 2 weeks I put out a market minute that goes exclusively to all my clients, explaining the strategy, how it's affecting their portfolios, and what they can potentially expect in the future because of what we're doing. It's important. So let's set the stage. In the next section is what we're going to do is we're going to go through how fees are hidden inside products. That's important. Why low cost doesn't always mean low risk. That's important. How commissions and revenue sharing influence recommendations. That's important. And why complexity is often intentional. Like I hate those kinds of systems. And how retirees unknowingly carry risks they never agreed to. And by the end of this episode, what I want you to do is I want you to have a filter for evaluating advice, and one that has nothing to do with personality, competence, or credentials, and everything to do with alignment. So it's like, oh, are you a CFP, or are you this, or are you that? That's not all that important. Okay. It's important, but it's not the most important thing. So I want to understand how hidden fees are hidden in plain sight and why most people never see them. When people think about fees, they usually think about what they can see, like what's your advisory fee, or what's the expense ratio, what's the management charge, and if that number looks reasonable, they assume the cost is reasonable. But visible fees are only a small part of the picture. The most damaging fees are embedded, and they're layered, they're obscured, and they're spread across product structures and decisions in ways that never appear as a single line item. That's important. And one of the things when it comes to layer fees, a lot of times retirees they pay fees on top of fees. For example, you got like an advisory fee on the account, whatever percentage that is. There's an expense ratio inside the mutual funds or ETFs. There's a sub-advisory fee inside managed funds. There's trading costs, there's platform fees, administrative fees, insurance costs, rider fees, mortality expense charges. There's all these different things. And when it comes to buy and hold, I think the fees are a lot higher because they're hidden in ways that you can't see. And each fee looks small on its own, but when you add them up, they erode your growth and your income potential over years. And that's very important. And that's why I don't trade a lot of mutual funds in our portfolios. I don't trade a lot of ETFs. We trade straight stocks and a lot of options. And what we are required to do is look for the best price execution we can get. So we're in a platform that's all they do. Their thing is price execution. And if they think I'm getting a bad deal, if Schwab thinks that the stock market is giving me a bad deal on a quote, they will kill the trade. They'll call me and say, Harold, these numbers don't look good to us. We think you can get it cheaper from a different firm or whatnot. Let's go over here and shop this quote and see if we can get it over here. I'm like, thank you very much, Schwab. You saved us some money. And sometimes if we can't get the deal done with a bigger firm or whatnot, a bigger trading house or whatnot, we just scrap the trade altogether. It's very important. And a lot of statements never show the total cost. And if you don't know the total cost, you can't really evaluate if it's worth it or not. You got to understand that. I want to talk about the low cost illusion. And a lot of products are marked as low cost mutual funds, but low cost doesn't mean low impact. And a fund with a 0.60% expense ratio may sound inexpensive until you realize it's in a managed account, wrapped in a portfolio model, paired with an advisory fee, and rebalanced frequently. Okay, that could be 2-3%. Now, as a fiduciary with an RIA, we're only allowed to charge a gross percentage of all your assets, and it can't go over a certain amount of money. No matter how hard we work, we're only allowed to charge a certain amount, and it can't go over a certain number. Okay. And suddenly that low cost solution may be costing you 1.5 to 2% annually, and you don't even know. And that can be a big deal. Some fees they never show up as fees at all. They appear as like reduced returns, underperformance, opportunity costs, lack of flexibility, penalties for exiting, missed alternatives. Oh, buddy, opportunity cost, lost opportunity cost are the worst. But you know why? Because most people don't calculate them. Well, this is free, Harold. These guys don't charge me anything for trading. Well, what can you buy over there? What can you do on that platform? What can you get? Well, I can only trade these mutual funds over here in this plan and my plan here. That's all they allow me to trade. But you know what? It's not costing me anything. Okay. Well, if you analyze those holdings and you went with a different strategy, let's just say we moved your money out of that plan. Say the rule of 55. I hear that a lot. Harold, rule of 55 says I can keep my money here. Okay. Well, what can you get over there? Well, we can only do mutual funds. Well, what's the performance? How have I performed for you over the last 5 years? We're up like 500%. What's my fee? My fee is 2.2%. Now, 2.2% over 5 years, that comes out to what? Like 10, 12, 13, 14%. And we made you what? 500. The mutual funds are only giving you maybe 15% a year. And we're talking about, what are we talking about here? Your lost opportunity costs are what's really hurting a lot of people. And it really gets them hung up on fees because they don't calculate it. They don't know what they're truly paying. They think they're paying that 2.2% or whatever it is straight up. It's like, I'm paying that. I'm never going to get that back because it's only relative if you're not making money to cover it. I mean, in a major way. And so, because it's not right there on paper, people don't question them. The absence of a bill does not mean the absence of a cost. Why this matters a lot in retirement, a lot of times, okay, and this is buy and hold. If you have high fees and you're only doing buy and hold, the fees are the same. The portfolio goes up, it goes down, it goes up, it goes down, it goes up, it goes down, it goes sideways. It's not being actively managed. So if it's actively managed and you're paying a fee for that, when the market downturn happens, your advisor moves your portfolio to something more conservative. When the coast is clear or becoming clear, they move it back, start layering back in. So they up and down the chain of risk. That's very important, but buy and hold does not. You buy it, you hold it, you pay the fees. It goes up, it goes up, it goes down, it goes down. Nothing changes. And that is tough. Now, a lot of retirees think that if the costs were important, somebody would tell me. Yeah, they should. But the system doesn't reward transparency. It rewards retention, complexity, inertia. Like complex structures reduce questions because you don't know what to ask. And questions reduce revenue. That's a problem. Okay. Now, the key question a lot of people never ask is, instead of asking how much is the advisory fee, here's the better question. What is the total all-in cost of this entire structure? That includes like fees, embedded cost, restrictions, trade-offs. Am I missing any lost opportunity costs? Is if I pay you this, are you sure that this program is going to take advantage of every single opportunity that the stock market provides us? And if the person can't answer that question, it's like, okay, then what are we doing here? Like, we're in this thing to make money, not to just pay somebody to squat on our assets and become like just a squatter, like collecting fees off of us, and we're barely making anything. That's a red flag if they can't explain that to you. Now, the next thing I want to talk about is hidden risk and what only shows up when it's too late. And when a lot of people talk about risk, they usually mean volatility. How much does this go up and down? But volatility is only one form of risk, and they're not the most dangerous one for retirees. But it's risks that are ones that they don't appear on performance charts, aren't obvious in good markets, don't matter until withdrawals begin. This means the stress test of the program. This is when you get into the sequence of return risk. And this is the risk that nobody really talks about until it hits. That's when you're taking money out. That's when you get into what they call portfolio failure if you're not earning the right amount of money and you're not invested properly into a good strategy. And another kind of risk is liquidity risk, and is when you can't get your own money. And a lot of times it doesn't show up in bull markets. It shows up when the markets go down and it shows up when you need to pull money out. And that's why flexibility matters. And it also shows up when options are limited. And so that's why you have to have your plan stress tested. Okay. But normally, if you're in a buy and hold and just buying mutual funds, that's really no plan. That's just hoping these things go up and they go up and up so that when you retire, you can get money out. Okay. A lot of times in retirement, these limited options, they're traps. And here's some examples like non-traded investments. Like it's hard to move them on the market because there's no market for them. Like long surrender schedules, lockup periods, penalties for accessing principal, and opaque redemption terms. Like some of these mutual funds, you get in them, like you got to hold them for like 90 days. And if you don't, there's this huge fee. Illiquidity is often framed as a feature, not a risk. But for retirees, you gotta have that. And we'll get into what you can do down the road here in a little bit. Here's the thing about the complexity risk, and this is when you can't explain your own plan. Like you don't even know what's going on with it. You don't even know like okay how this process works, or and I'm not saying that you got to become an expert at it because if you were an expert at it, you would probably be the one facilitating selling the plan or whatnot. But still, though, you need to understand how these things work, like the cost, incentives, how frail they are, and what are the unintended consequences. Now, complex strategies, they may appear sophisticated, but sophistication doesn't equal resilience, right? In retirement, simplicity is not a weakness, it's a strength. And a lot of times, if there's a lot of complexity in there, it's to justify fees. Like we got to do all this, we got to do all that, we got to do this, that, and this and that. It discourages questions and it increases dependence, and you become codependent because you don't know how it works and what else is out there. So you just become codependent, and sometimes it feels like you're being bullied financially by an advisor, and that's not good. And I've had people become bullied by other people telling them crazy things, telling them that they're stupid if they leave, all of these different things. And it's not good. Concentration risk. I think we've talked about concentration risk a lot. And this is like overexposure to one sector, reliance on a single strategy, like all life insurance and nothing else, and or all real estate and nothing else, or I just want annuities and nothing else. I just want all silver and gold and precious metals and nothing else, or I just want all crypto and nothing else. And basically your confident in a dominant narrative, like this is the thing to do. And narratives, yeah, they create comfort, but comfort creates concentration. And that's a problem. People do more of what they're comfortable. They want the most of it. And when that just goes downhill, we're in trouble. And a lot of times we look at, like, say, going to bonds and things like that. So I want to talk about the bond myth and I want to revisit that. A lot of retirees believe that bonds reduce risk. And I've already talked about that in another show that in 2022, bonds went through the floor. Rates went higher, but the bonds themselves went through the floor. So a better alternative would have been treasuries. Again, everything I'm talking to you is about a strategy of buying, hold, and not having a portfolio that's actively managed. Okay. So the next thing I want to get into is the myth of objective advice. A lot of people assume that financial advice is neutral, and they think that recommendations are based on what's best. What's best for who? And professionals, a lot of them are rewarded for outcomes, and advice is aligned with the client's success. But that's not always true, right? But for us, our advice is always aligned with our client's success because I got to the point where I built my portfolios based on the same advice that I give to my clients. So if my clients follow my advice, they have the same kind of money in their portfolios as I do. I don't do anything different. And if everyone decided to leave today, I would still be okay because I'm managing my portfolio the same way I'm managing theirs. And my portfolio, thankfully, has continued to outperform. And that's what it is. So I don't let money incentives cloud my judgment in terms of what I'm telling a client to do. And this is very funny when people push back on things sometimes, like when they push back and I'll give recommendations to move money here or there and they push back and like I don't want to do that. It's like a lot of times in my mind, I'm like, I don't need their money. I don't need them to move the money to me. I just don't. I'm good. But they themselves need to move the money to me for themselves because of what we're able to do, right? It's not hurting me if they don't move the money over. Like I said, I'm good, but it's hurting them if they don't because they're missing out on opportunity costs that are just unreal. And commission versus fee, that doesn't solve the problem. A lot of people think just work with a fee based advisor. A simple fee is all I want to pay. I don't want to pay fees on my portfolio performance and stuff like that. That's fine. That helps, but it doesn't eliminate incentives. And fee based models, they still require asset gathering, asset retention, product selection, portfolio complexity. And if compensation depends on how much money is managed, how long assets stay put, how difficult it is to leave, the recommendations are influenced even subconsciously. And that's something you got to think about. And a lot of times complexity is often rewarded, but simple solutions are easy to question. It's easy. You can see it right there. Harold, why do we have three buckets? Why do we have the short term, intermediate, long term bucket? Why can't we just leave everything in one bucket and just make it low risk? Because it's not going to work. And complexity makes comparisons difficult. It discourages second opinions, it reduces transparency, and it increases dependence. And that's not what we want. We want you to be financially independent. Okay. And some models, they keep you invested, like they're designed to keep you invested no matter what. And that's a problem. And this is when you often hear is don't go to cash, right? Don't move to cash. Why? Because they don't get paid on cash, right? Our firm, look, your portfolio, basically, you are being charged a fee, whether some of the money's in cash, whether it's not in cash. Why? Because it's being actively managed, right? You'll never be in all cash for an entire quarter. You'll be in cash-like assets, right? Something that pays you more than cash. And that's why it's so important. They'll say, stay fully invested. Time in the market beats timing the market, things like that. And a lot of times, I'm going to tell you, time in the market is true. I'm going to tell you that's not necessarily a myth, but it depends on how they say it to you. And you got to be careful with that. And you got to be careful when people are pushing products versus a design plan. And when it's a product, the focus shifts to what to buy, what to allocate, what to move money to, rather than the other most important thing. And the last thing I want to get into here in a second is look. You have a right to ask questions. Instead of asking, like, do I trust this person? The better question is how is everyone involved in this recommendation getting paid? And if you're working with a fiduciary, you already know. Transparency is what we live by. Because if you don't have transparency, you don't have nothing. And what happens if there are conversations if I do nothing? If the answer is unclear, then that's not transparency, that's avoidance. Okay. So the goal of this conversation is not so that you become distrusting. It's about aligning the objectives. My thing with the rapid retire financial planning process, number one, is to be fully transparent. Number two, it's about aligning your goals with my mission. And my mission is to help people avoid becoming one of the 97%. Like 97% of people can't retire with all the money that they're going to need, okay, to last them their entire lives. That's very important. If your goals align with my mission and there's a win win situation, then that's full transparency. And that's why I created the process called Rapid Retire, because it is built around structure, not sales. It emphasizes income flowing before growth, segmentation before allocation, liquidity before optimization, and behavior before performance. It's designed to reduce the impact of hidden fees by simplifying the structures. It's designed to reduce hidden risk by matching assets to time horizons, the three buckets. It's designed to reduce incentive conflicts by focusing on outcomes instead of transactions. Like, we don't get down like that. And most importantly, it gives retirees a way to evaluate decisions before stress exposes weakness. And it's going to give you confidence, right? And when you have confidence and you understand how the plan works, like, Harold, where the money comes from every year. Well, in your plan, the money for these trips is going to come from here. The money for this is going to come from there. The money for this is going to come from there. It's going to come from this bucket. It's all laid out. So you can retire with more so that you don't have to live less. Does that make sense? And when you have clarity about that, it's calming. And you don't have to worry about what happens if there's a 10 to 15% in a correction in the market. You don't have to worry about that stuff because there's a strategy behind all of that. And I'll close by saying this. The purpose of this episode was not to create suspicion or like be looking over your shoulder trying to like find every little fee that you're being charged by your advisor and then questioning their actions. That's not the goal of the show. But I wanted to give you awareness of how costs really work, how risk can be hidden, and how incentives can influence behavior. And once you have that awareness, you no longer need to rely on trust alone. So no more checks for blank trust. But bro, Harold, I trust you. You got this. You know, you're doing a great job. I don't worry about none of this stuff. I don't even look at my fees. I said that's all fine, but don't ever tell anyone like an SEC auditor when they call you, have you seen your fee statement lately? No. Has Harold sent you one? No, that's not true. You just never looked. It's in your file. I tell people that. Look, make sure you go check. Okay. Because I don't want you saying I never sent you anything because we download it in your file and we tell you where it is. Some people are just so trusting, and I appreciate that. But I only want that trust because we have a structure. And I don't want to be like one of these advisors that says, "Oh, my clients trust me, so I don't need to worry about this. I don't need." You begin to take things for granted. You begin to become cavalier with your decisions, and that pressure to make sure you don't get it wrong. When people trust you all the time, and you take advantage of that, and you take it for granted, you can make bad decisions, and I don't want to do that. So if this episode made you realize that you've never been shown the full picture or that your current plan feels more complex than confident, this is the right time to step up and reassess what's going on. Not emotionally, not reactively, but deliberately. And you can do that by visiting my site, www.brightfg.com, and click on the contact link and send us a message saying, Harold, this is my situation. What do you think? You have time to talk to me. Bev will get in talk. What we'll do is we'll look at the fees, we'll look at your risk, we'll look at the incentives, we'll look at your structure, and we'll look at your plan and hear you out and then see, are you on track to accomplishing what you are trying to accomplish? Look, I ain't got nothing to sell you, but everything to tell you. I have nothing to sell you, but everything to tell you. And then you can go and make your decisions from there. So thanks for joining me for episode 7 of the Financial Advice versus the Financial Propaganda series. And if you found this episode valuable, please share it with people who you think that they need more clarity and less complexity in their retirement planning. So I want you to stay focused on what you're doing, stay focused on your goals, stay disciplined in your goals and your objectives, stay aligned. All right. And it's about winning and not losing. And I want you to start winning your retirement game. And until next episode, everybody, 1, 2, 3, let's get it.
This is thepodcastfactory.com.